Welcome to the PI World webinar on the 2nd of April 2020. I'm your host, Tamsin Freeman. Today we will discuss the markets with John Rosier, and at the end there'll be an opportunity to ask your questions. John, thanks so much for joining us here today. For those who don't know you, give us a short overview of your background.
Okay, well, good afternoon, everyone. So my background, I spent 25 years in the city after graduating as an analyst and investment manager. I mainly managed long-only equity portfolios, UK equity portfolios, for final salary pension schemes for corporates and local authorities. And I also managed some charity money as well. For the last 10 years, I've been managing my own money. And after doing that for a year or so, I had the idea of John's Investment Chronicle, which I launched in January 2012. It's a real-time record, warts and all, of what I'm up to on the investment front. And I thought there was an opportunity, as there are plenty of tipsters around, that they normally remind you of the good ones and quietly forget the duffers. They also forget to tell you when they've cut. There are also some who, update their trades on a weekly basis. I do it within 15 minutes of any trade. So there's no scope for me to, in inverted commas, forget to enter a trade that the next day issued a profit warning. Essentially, my members are my auditors. So I have to live with my errors, and like any investor, I make a lot of them. But if you can get more than 50% right, I should be okay.
Absolutely.
Or you should be okay. And then one other thing, just anyone who reads, my monthly review in the Investors Chronicle magazine will see I openly admit to my mistakes. Only yesterday, when writing up Watkin Jones's COVID update, I said in my conclusion, do I regret having bought it? No, I just regret the timing. If I'd waited another 3 days, I could have bought it 30% cheaper. So that's what was going on a couple of weeks ago. Very, very fast movements in stocks.
Absolutely. So you've been through various bear markets. What have you learnt from them that helps you today?
I mean, first of all, I just need to emphasize that I'm not here to persuade anyone to do anything. People have to make their own minds up, do what they feel comfortable with, and also which suits their objectives. So, I'm purely saying what my thoughts are and describing what I'm doing. And probably in this next hour or so, there'll be lots of I don't knows and I thinks. Because the truth is, none of us know with any certainty what the sort of short-term outlook is over the next, few months or so. Anyway, I reckon this is my sixth bear market. I mean, the chart here is showing UK bull and bear markets. I think there's two missing from that, actually. I think 1998, which was pretty short and sharp during the summer, the Russian and Far East debt crisis and the long-term capital management hedge fund in the US going bust. And also 1990 to 92, I'm calling that the ERM crisis. But from the 3rd of January 1990 to the 28th of September 90, the FTSE All-Share was down 22%. So that's a bear market in my mind. But I can tell you it certainly felt like one at the time. So the main thing I've learned is that they're all different, but they're also all the same. So different in terms of cause. If we go back to 1987, there was a valuation mismatch against bonds. It's easy to say that with hindsight. And that led to, that very quick panicky sell-off and Black Monday. 1992, that was more due to a cyclical slowdown due to high inflation and interest rates being put up to bring that down. If I remember rightly, I think in 1989, inflation got up to 9% or 8.9%. And it's difficult to believe that in these days of sort of 1 or 2% inflation. But in that case, the squeeze went on longer. Interest rates were held up longer than they needed to be in order to try and maintain our place in the ERM. 2000, 2003, we had the dot-com boom with valuations obviously very extended on those sort of stocks. New valuation measures like the number of clicks a website got and things like that. And obviously that wasn't helped by 9/11 either. Then in 2007-8, we had the financial leverage in the banking system, which nearly brought the system down. And now an external event, which not many people really foresaw, certainly a few months ago, with COVID. Just in the way that they're the same, I think they're the same because they're always tough and they always mess with your mind. Time dents the memory a bit, but 1987, no one was saying, wow, this is a huge buying opportunity. Everyone was very worried then about what the hit to the real economy would be. At Fleming's, where I worked then, the decision was taken to sell all our US equity positions. And that was a big mistake. It came bouncing back. And, 2008-9 was awful. People were, generally worried about the breakdown of the capitalist financial system. Is my money safe in the bank? And no one rang a bell on Tuesday, the 3rd of March, 2009. But 3 months later, it was up 30%, 6 months later, 43%, and a year later, 65%. So I've always been, rather worried about having too much cash, especially after we've had such a big fall as we've had in the last couple of months. There's a rather nice little thing I saw the other day from Ian Cassell, who's founder of the Micro Cap Club. And he said, when you're sitting on a big cash position, because you have the ability to take advantage of a drawdown like few others do, it's easy to become too bearish. You wake up, excuse the language, pissed. The market isn't down more and it paralyzes you from pulling the trigger on anything. Yeah?
So what's your view on where we're at and the outlooks for markets in the short and medium term?
I mean, this shows previous bear markets looking at the S&P 500 index in the US. And I mean, at the end of the day, we do tend to rather follow what happens in the US. But you can see the latest bear market in context there. So it's been very rapid, the 1 month fall basically from peak to bottom. But it does match the average for all bear markets with that 30-odd% decline. But, we have had some pretty awful ones in more recent history, like the 56% drop in 07 to 09 and 49% at the beginning of this new century. And that just shows, the UK. And these stats were provided by growthcompany.co.uk, who produce an excellent monthly edition on sort of small and mid-cap stocks. But again, you can see what we've seen in comparison to previous ones. So again, maybe 35% isn't enough of a fall yet, especially in the context of 03 and 09, and also the speed of it just for 4 months. I mean, where are we? I think and hope that we've seen the peak in volatility. I mean, people look at the VIX index and that shot up. And while I'm not saying that therefore we return in terms of volatility to the historically low levels we've seen in recent years, so that's not going to happen in a hurry. Hopefully markets will move much less in response to bad news as it comes through. I think a lot of the bad news is now being discounted. And I guess the only risk to that is that it gets a lot worse. And I guess that's what a lot of people might be fearing. Did we see the bottom in mid-March? Again, I really don't know. And as I say, if you look at what's happened compared to previous and more recent bear markets, one might think with all this terrible news around that maybe 30 odd percent isn't enough, and maybe it needs to fall 45, 50%. But I do think we've had most of the fall. Time will tell on that front. Clearly, Q2 is going to be an absolute disaster from an economic point of view. Earnings are going to take a huge hit. You see that again is looking back since the war, and again, I'm afraid it's US figures, but you can see what's happened in terms of earnings from peak to trough. And I guess, this time with basically economies being shut down pretty much, you'd guess it's going to be worse than 2008. This shows the rebound you saw after previous sort of recessions and earnings falls. They do tend a year later to rebound very strongly, and the more of the fall, the more of the rebound. And I have to say, I am more in the V-shaped recovery camp, because I just think there's so much cash being pumped into the system, either fiscally or monetarily. And I think when we come out of that, on aggregate, looking across the economy, that there's going to be huge pent-up demand. Obviously, some areas will take time to recover, like, I guess, airlines and cruise lines and all that, those sort of things. But I should think, general spending will pick up pretty quickly. There was a Chelsea pensioner this morning on Radio 4's Today programme, and he was asked at the end what they'd be doing when this is all over, and he said having a massive party. And I think you'll see that sort of across the economy. We're social animals, and we don't really enjoy, I think, being locked up. I mean, it's mind-boggling, actually, the amount of fiscal stimulus that's being put in place, and also the monetary stimulus that's coming through. I mean, I read yesterday, I think the Bank of England needs to issue £45 billion of gilts in April, which compared to previous months, it's just enormous. And people think, well, will the market take this? Well, the simple answer is the Bank of England will buy it. Then looking forward, I just cannot see the current government, or probably any government, being in any mood to ruin the party when we come out of all this. A return to austerity, unlikely. Universal credit was increased by £1,000 per annum. I think that's great for people on universal credit. Can you see that being reversed in a year's time? Absolutely no way. I don't think there'll be a short or medium-term plan to reduce debt. It will become a long-term wish, and we're probably only a short step away from writing a lot of this off. In other words, real money printing. So that's really on, where I think we are now. I mean, we could see the market go lower, but I think in summary, we've seen most of the volatility.
So how are you positioned going into it, and what's your strategy going forward?
Okay. Well, readers of my monthly piece in the Investors Chronicle magazine will know that in January and February, I was concerned that markets were being complacent about the disruption to supply from China due to COVID. So I'm not claiming I thought that what has now happened in Central Europe would occur. I don't think anyone really thought that. I mean, if you look at the minutes of NERVTAG, which I read yesterday, of the 21st of February, they some of the eminent scientists in the UK, they voted against moving, to a high degree of concern about COVID. They kept it at medium, and that was only 5 or 6 weeks ago. So I wasn't concerned about that. I was just concerned about the disruption to Western economies from the supply disruption from China. So I had increased at the end of February, it's there in that review, I'd increased my cash to 11%, which I think is the highest I've held in the last 8 years or so. And I'd increased my exposure to gold to around 20%. So I had 8% in physical gold ETF, and then I then had exposure to gold miners through Anglo Asian mining, the LNG Global Mining ETF, and the VanEck Junior Vectors Junior Gold Miners Index.
Were you in gold before January?
I started buying it sort of second half of last year. But slowly, I really increased it this year in January and February. And again, for me, it's a bit of a new one. I'm not that keen on gold, really. It doesn't pay you a dividend. Although at the moment, not quite a lot of stocks don't either, but it doesn't pay you a dividend. But I think what attracted to me more last year was that the old argument of sort of opportunity lost in terms of what you could earn elsewhere. Well, you were earning nothing from bonds or interest, from interest-bearing instruments, and therefore the opportunity cost of holding gold was pretty much zero. And also the other side of it was I just felt with negative, interest rates, etc., and a lot of economies and things that was just mad, and that ultimately we're going to see some pickup in inflation. So that's where I was at the end of February. Early in March, I increased that cash further to around 16%. And I sold or reduced stocks which I thought would be hit the most by a slowdown in the UK or recession. So stocks I sold, which all look clever with hindsight, were Strix, the kettle control manufacturers. So I sold that completely at 188p. I halved my STI group at 89p. I sold Anglo Pacific completely at 170. I sold TR European Growth completely. I halved my Baillie, Gifford, Shin, Nippon, and I halved my Robo Global Robotics and Automation ETF. And the mistake was actually I sold all my Scottish Mortgage Trust. That's held up very well. There's a great little podcast produced by Baillie Gifford the other day, which you can find on their website. And I listened to that, and surprise, they hold Zoom. They just dropped that in quietly, but there you go. They are invested in stocks for the future.
And what didn't you get rid of?
I halved my Games Workshop as well at £65. So areas that I hung on to: Worldwide Healthcare Trust, Biotech Growth Trust. I mean, both of those seem to me they're just going to be huge beneficiaries. It's a theme I like anyway. In terms of growing expenditure around the world on healthcare as a sort of theme, with growing and aging populations and countries becoming wealthier. But I mean, this COVID will only accelerate that. I held on to Renew. I mean, my thinking with Renew was that it's involved in the critical infrastructure maintenance, and therefore spending from the government on that wouldn't stop. I hung on to Bioventix. Unfortunately, I reduced that last year, so that's another error. Again, a good stock with strong barriers to entry, very, very high returns on capital, and loads of cash flow and a great balance sheet. So good results from them the other day. Glad I still got some of them. My biggest mistake, and I sort of kicked myself for this, was not cutting my exposure to energy or oil. So Rockrose Energy and Serica. I mean, the price collapse was quick, and I was too slow to react. I was sort of seduced a bit by Rockrose's financial position, which, as long as the oil price has recovered in a year's time, which I think it will, the pain to Saudi Arabia and Russia is acute, but they're playing a game at the moment. But ultimately, I think we'll see that go higher again. But I thought that Rockrose's financial position would protect it. So that's a bit of an embarrassment, really. I've done a nice round trip in that stock. Great success in 2019, but so far not in 2020. So that's what I did. And then I've reinvested So at the moment, I've invested all my cash back in, so I'm pretty much 100% invested. So the stocks I bought in March, mostly from about March the 15th onwards, I bought back many positions like Strix, the Baillie, Gifford, Shin, Nippon, the Games Workshop, and the Anglo Pacific. But I've also added a few other names. So MONY Supermarket, Watkin Jones, Paypoint, and Schroder Midcap Fund. So what I'm trying to do is buy stocks which will survive. So that's the number one thing. And have a good franchise so that they can recover as and when things return to normal. One other thing that I've done, so I said I've added those 4 positions. So I've gone from 24 positions to 28. And I intend to get up to 30. So what I'm effectively doing is reducing my individual stock level risk. And only last week I reduced some of my Sylvania Platinum at 40p, down to 4% of the portfolio. So a stock I like, but reducing it to 4 was just part of raising some cash so I could increase my number of stocks up to 30. But also buying the Schroder Mid-Cap Fund, that's also something where I'm obviously reducing my specific stock risk and buying more of a sort of mid-cap risk. But that had fallen to a 20% discount to assets. And I mean, a lot of investment trusts have. And that's just, I guess, where people are just going, I need to get out, I need the cash. And they're selling the shares and forgetting what sort of discount to the actual underlying assets that they're selling at. So it's likely, with 28 stocks at the moment going to 30, it's likely that the next 2 purchases will be investment trusts. And obviously I want to try and get back in the Scottish Mortgage Trust at some stage. So we'll see what happens. But as I'm 100% invested, that will have to be funded by reducing some of my existing positions. And then gold, I've reduced that a little. I've currently got 16.4% in the 4 positions. And I sort of intend to keep that because I think it could perform very well, especially if there is some inflation, which I think actually the Bank of England would probably tolerate. Because and also the problem is with inflation is once the genie is out of the bag, it's quite difficult to get back in. So I've got that there as a sort of hedge.
And was there anything you were specifically looking at in order to make the decision that it was time to start buying? Because I think a lot are sitting on their hands.
I mean, a lot of it comes from looking at sentiment indicators. It's very easy to get wrapped up in the news and how people are talking about the news and to feel very bearish about life, not just because of what's going on in the financial markets, but your phone flashes up with news of more deaths and young people dying, all sorts of things like that. And you can try. I try and get away from that by actually looking at what's going on and what real detail is. So you've got this slide here that was tweeted out by Ed Conway of Sky, and it just puts, the fall in UK share prices over the last couple of months or so, and it was bigger than in any 3-month period since the South Sea bubble. So yes, it is awful, and we know it's awful, but Black Monday was pretty awful. I wasn't around for Dunkirk, but I'm sure that wasn't too great a period. The Depression in the 30s, etc. So it puts into context what we actually went through over that couple of months. There's a great chap to follow on Twitter. He produces, I think, really good charts and things. And this is just looking at the put-call ratio, again in the US. So basically, if everyone is bullish, they're very long of call options. And they tend to be that way at the top of markets. If everyone is bearish, they tend to be long of put options, thinking the market's going to go down further. And this basically charts the balance between the two. And you can see how the other week, March the 18th, it moved up above that dotted line So going back to 2004, that's the highest it's been. And the other peaks were basically towards the end of, in 2008, after the Lehman's collapse. Wasn't quite the bottom for the stock market, but wasn't far off. So basically, again, that's showing you that a lot of people were very bearish on that day. And therefore, one should take comfort from that. This is a good one. This Sentiment Trader, again, produces some good charts, and again, is trying to record what's actually going on in the market. And it's saying what's happened to the S&P 500 after a more than 4% gain, with less than 70% of the stocks going up. And this goes back to 1962. And you see, a lot of people might think, oh, if the market's up 4%, you want every stock to be up, because that shows that everyone's bullish and things are going to carry on recovering. So on there, you can see basically it's more what's more interesting, I think, are the green dots on the line are when that happened before, and then the chart at the bottom shows where the market was 1 week later, 2 weeks later, etc. What interests me more is where things are in a year's time, because calling what's going to happen on 1, 2 weeks, a month, 2 months is very difficult. But over a year, you can see 100% of the time the market was higher, and by quite a lot. I mean, the best was 38.3%, and the worst of them was 15.9%. So, again, that gave me some comfort. So that was the Financial Times front page. I don't know, that looked pretty gloomy to me. Filling up the front page like that. Sterling was down at completely collapsed down to about 114.15, etc. So that was one. I normally subscribe online to the FT, but I went outside and bought a paper copy because I want to put that on the bookshelf, because it'll be an interesting one to look at in 10 years' time. So this one again is showing what happens when the utility sector rally more than other sectors. And basically, again, you'd think, well, that's people buying utilities because they feel safe with those, because the dividends are unlikely to be cut. People have to still use utilities. But again, it can be an indication of when you're pretty much near a low. Not as strong as the others, but generally, when this has happened in the recent past, it has meant we're near the bottom. But those are the things that really gave me comfort, because it took me away from all the noise and people's opinions, and showed me what people were actually doing. I mean, in terms of what I'm looking forward to, going forward, I think people are going to start paying a lot of attention to every little bit of news on COVID. And trying to see some signs of hope. I think there is some signs of hope in place. I mean, obviously, whether people can argue about China and how much they believe the numbers, etc., but at least that does seem to have come out and be trying to get back to normal. But also, if you just look at Italy yesterday, there was the 5-day average of new cases in Italy. It was 4,815, and that was the lowest 5-day average increase since March the 16th to 20th. And it's these sort of things I think people are going to look at. And obviously in the UK, we'll be looking at the UK cases and the same in the US. But I think that we're all going to be looking for what the exit plan is. And I think, give it another month. It's not that far away, end of April, beginning of May. I think that will start to become a lot clearer. And so, although economies are going to take a hit and everything, I'm just not sure that the economic data is going to drive things quite as much as sort of people looking forward to coming when we come out of this. Unemployment figures and numbers, etc., are going to be awful. But I think we sort of get that. And the worse it gets, the more money will be pumped in fiscally, by governments, checks being sent to people, etc., and monetarily by, the Federal Reserve or, the Bank of England in the UK or the ECB, etc.
You're not worried about a complete global financial collapse?
Well, you see, I mean, that was what I think you had to worry about in the last crisis. But the banks are in a much better position, number one. And number two, everyone looks back and says, oh, the world reacted really well to that. But actually, you could say in 2007-8, the world was a bit slow reacting to it. The first warning signs were in September 2007 when there were queues outside Northern Rock. But it was another year till, when Lehman's was allowed to go bust, and then, all the banks, central banks, etc., got together to rescue the system. Whereas this time, the response has been very, very fast, incredibly fast. Great credit, I think, to the authorities on that front. So you've had fast reaction, and it's been huge. No, I'm not worried about the global financial breakdown. No.
But if you've got something like Easyjet, all their planes are grounded, so they're going to have no revenue. And there are lots of companies like that. And government support can't really give them that revenue.
No, it can't. But if the government is paying 80%, I mean, what are the costs for an airline? The huge costs are people. The sort of operating costs are people and petrol, kerosene, and also sort of landing charges and all those at airports. Well, the people costs. The government's now, you saw British Airways today, people are now being sent home because there's nothing for them to do. And the government's paying 80% of their salary for them. There aren't any landing costs and there's no fuel costs. So their actual operating costs are pretty low. And as long as they can meet their debt payments, and I'm sure there will be accommodation on that front. I mean, ultimately, those aeroplanes which are sitting on the tarmac will be flying again. So, how do you value something like Easyjet? I mean, I don't hold Easyjet, and I'm not sure now is the time to buy them. I'm sure it is on a 6, 7, or 8 year view, 5-year view. You probably make good money, but with that one, maybe it's got lower to go. Who knows? But at the end of the day, it will make earnings again. It will generate revenue and profits and pay dividends. So, it doesn't mean that's the end of that company. Its assets are still there, and that's where I see a lot of those sort of companies. It's a matter. An interesting one was international hotel groups. That's up 50% from its low. They put out an announcement on, 20th March, something like that. And, in that, they pointed out that, only 65 of their 180 Chinese, based hotels were still closed. They'd managed to reopen the others. And, revenue was starting to pick up. So, these things are of a temporary nature. It's just a matter of whether it's 1, 2, or 3 months or so. But I think we'll come out of it.
It's nice to hear that. I'm just going to ask you a question that was sent in advance, and that's from Ben Sharman, who says there are very few industries, sectors or businesses that haven't been affected by the coronavirus and the heavy falls on the stock market. Can you take us through your process of identifying the best opportunities in the current market? What are the main qualities you look for in a business, and what attributes would hold you back from investing? And can you give a few examples?
I mean, I make use of things like Stockopedia, where I have my own screens where I'll be looking at things like quality screens, return on capital, etc., or price to cash flow screens, or debt, making sure companies don't have too much debt or they can meet any debt payments they have. So screens like that. So that can throw up ideas, and then you've just got to look at what statements they've made and make judgments as well as to whether you think the business will be carrying on. So something like Bioventix we've mentioned earlier on, I mean that will be hit minimally, if anything, by the current crises. And yes, it's got a very strong balance sheet, lots of cash, etc., high returns, good moat, etc. And basically, I think that crises like this, if there's trends already in place, can accelerate them. So, digital, I'd say, stuff or areas will do well, and will continue to do so. So things like Amazon, I should think, it's doing very well during this time. Then Microsoft, I know a lot of people are talking about that, but again, should just benefit and accelerate any trend towards the sort of cloud computing, etc. I bought MONY Supermarket recently. Again, that's something I think pretty good returns on capital, pretty good cash flow. I would hope will come out of this in a stronger position than it went into it. I guess there must be another nail in the coffin for the high street from this. And when you look at shops sort of closing anyway, I guess this might accelerate that. So what will happen to rental yields? Is that going to have a reset where there's only so many charity shops you can cram into your average high street? But then a stop like Next, that's on my watch list. Quality management, and they've got a decent amount online through directory, so they could well be a huge beneficiary, a big beneficiary as we come out of this.
Although today they mentioned that they're trying to sell their warehouse and 2 freehold properties, I think.
Yeah. It's going to be tough for people, but Next have always been very good at capital management. So the fact that they're doing that, you've got to remember that, when the next recovery started in 1990 odd, in the early 90s, at that stage they sold Grattan. David Jones did the mail order business, and made a lot of money, which sort of saved the business there. Well, I don't think Next is anything. It's not anything like that at the moment. But I think this should be a good one when we come out of it. I'm sticking with things like Worldwide Healthcare and Biotech Growth Trust. And again, another mistake. Why did I ever sell any of my Worldwide Healthcare? It's 800p. I first bought it in January or February 2012 in the JIC portfolio. It's now £28. Plus, I've had small dividends along the way. I mentioned, when you look at if you're feeling like there will be a recovery, the problem I have is that quite a lot of the sort of easy money ideas will have gone up a lot. And I say easy money in quotes because I shouldn't really say that, because if it was so easy, why didn't I buy them? And I didn't. But you look at a lot of the utilities; they perform well, and obviously the supermarkets and areas like that. If you're buying for some sort of recovery now, would you buy the supermarkets? Their short-term figures are going to be fantastic, I would have thought, with the increased buying, etc. But there's too much competition in that market. There's some big private players, as we know, the Aldis, etc., forcing pricing down, etc. So it wasn't in an industry I wanted to be involved in. It's having this sort of short time in the sun, but I think in the future it will still have the same problems as it has now. And so actually you're probably going to make a lot more money from a lot of the stocks that have been maybe hit too far, like I talked about International Hotel Group, where you have a lot of operational gearing to any recovery. I mean, you probably don't want to take the risk of taking things with financial gearing in case it gets worse and that sees them suffer and the worst happen. But operational gearing, if you get involved with that at the right time, that's obviously where you're going to make the most money.
And Ron Beckson has a question where he says, "Hi, John. What's the likely effect of low oil prices on a recovery in stocks?"
Outside, companies that are directly involved in the oil and gas industry, I mean, low oil prices for the Western world should be a huge beneficiary. I mean, it's like a tax cut. If it's costing you £15 less or 20 or £10, whatever, to fill up your car with petrol, then that's money in your pocket. And across an economy, that's quite a lot of money. And obviously in the US, I think we're already seeing it. There's sort of a lot of these shale gas operators now, and shale oil and gas going bust. So they're defaulting on their bonds that were used to finance the business. And I mean, that's the plan of the Saudis and Russia. It's to put them out of business. And I'm not quite sure how quickly actually people will rush back to invest in shale gas if they've lost all their money. In short, low oil and gas prices should be good for the economy and for other companies. For oil and gas companies at the moment, obviously it's disastrous, especially ones that are have higher operating costs. But I think the oil and gas price, or the oil price, will rebound, but it's really a matter of timing, and that's all down to the Saudis and the Russians as to when they come together and decide that they've caused enough pain, because they need the prices higher, I can tell you. Otherwise, the young Saudi population won't be happy.
Let's go to Bishan Ruhi, who has a question to ask.
Hi, John. Good afternoon to you. What is your overall view on the UK residential market, in particular with the construction companies that are now basically have come to a halt?
I think it's quite interesting. If we're talking about the house builders and we go back to 2007, 2008, that was the bargain basement time to buy a lot of those, because again, they'd gone into that situation in a very different financial situation to how they are now. They were much more sort of geared, and activity basically just fell away very quickly, and financially they found themselves wanting. This time they've gone into things in a much better position, so that I think they can weather a period of inactivity. So again, it's just really the amount of time you see this going on for. I mean, if you're mega bearish and you just think we're going to be locked down for months and months on end, and things are going to take years to get back to normal, then it'd be too early to invest in those. But if you were looking, and thinking that come the autumn this year and things will be looking a lot better and things will be recovering, then I think they're probably quite a good bet. But I'd go for the ones with the healthier balance sheets, and but they all seem to be in a pretty good shape this time.
We'll move on to Mark Toucan.
Are you seeing any clear evidence of market capitulation here in the UK?
I mean, what I'm looking at with quite a lot of stocks is the volume. The sort of daily volume in them, and certainly, a couple of weeks ago, during that sort of Monday, the sort of, what was it, 16th, 19th, that sort of part of March, there were some quite big spikes up in volume. And so that's one thing that, I picked up on. Whereas actually, if I look at the volume in a lot of stocks, certainly that I'm interested in over the last few days, even if they're down, it's on smaller volumes. So I don't see as much selling pressure at the moment. Now, maybe that would pick up again if we had another spike down and people felt they had to get out. But I think, a couple of weeks ago, we did see quite an increase in some of the volume. So that maybe is some indication. And then another indication to me is there's quite a lot of people out there sort of telling me how much cash they've got now, or, they've sort of halved their position and, they've sold half their holdings, they're half in cash and that sort of thing. So have we seen maximum capitulation? I don't know, but it didn't feel that great 2 weeks ago.
Robin Maxwell, do you want to unmute your microphone, Robin?
Hi, Tamsin. Hi, John. Robin here. I suppose my question is, do you see any risk on the horizon of, a significant rise in interest rates if the central banks, for whatever reason, decide they won't take it?
I have seen some sort of stuff on this, which suggests. This is huge compared to anything that's gone before, and the 2 trillion in the US is higher, I believe, in real terms and stuff than during World War II and things. So I think what the premise of your question is correct, and will it lead?
I suppose it's the bit of the whole thing that really frightens me most about putting all my cash back in the market. Yes, is that we are going into an unknown when it comes to how the hell we finance this moment.
Yeah, well, I think we are going into an unknown, in that I think we are at the time of sort of helicopter money. QE, you could argue either way. Was that printing money? In some ways it was, but they always argued that they could get rid of it again, the money they'd printed if they needed to. But I think with this, the amounts are so much that it will be fudged. If we were in this situation on our own 40 years ago, we'd probably be ringing up the IMF. But now we're not, because everyone's in the same boat and everyone's doing the same thing. They're just printing loads of money, which, could or should, I think, lead to higher inflation. Now, the question is how much higher? See, I don't think there'll be a problem with issuing it, because I think they'll just issue it to themselves. You see what I mean?
Yeah.
And so, the government will get the money it needs to do what it wants to do with it. But the risk is, yes, higher inflation at some stage, in which case I certainly wouldn't want to be holding bonds. I'm glad I've got some gold, and equities also as a real asset, I would have thought, would do well over the time. Although if it's really savage like you're implying, then maybe it would get hit hard to start with.
Can I one follow up then? Just let's assume that interest rates stick around zero or thereabouts for the foreseeable future. Which parts of the property market in this country, if any, would you be tempted to go back into?
In this country, I don't. Well, I'll tell you one that I have bought a couple of weeks ago. Well, actually, I bought it on February the 28th or night. It was the end of February, so I talked about it in the Investors Chronicle thing, and that was the Aberdeen Standard European, basically logistics REIT, or income trust. And so what that is doing is investing in European, Germany, Spain, etc., in sort of warehouse. And I would have thought that's an area that will do pretty well, because even if we have a move, well, a number of things could move it along. I guess if people decide they're going to hold more stock rather than relying on just in time, if that comes out of it, that's going to see demand for warehouse activity, but also, increased sort of online shopping, etc., will also see more activity in that area. That's paying quite a good dividend yield. It's done quite nicely for me. It's I'm up 9.5%, and that's during and already had one dividend, and that's during a month where obviously the market's taken a hammering. So would the same thing happen in the UK if you can find something involved in that area? I'm not sure I'd be that keen on high street, but again, I haven't really looked at the valuations and what's being discounted, so I'm not sure. But I'd have thought warehouse and that sort of area is an area that you would hope would continue to grow, whereas maybe offices will be under pressure. People at home using Zoom, I don't know.
So we've got a question from Gavin Laidlaw, who says, are you not concerned about the input of company guidance when it begins again to estimate valuations?
Yeah, I mean, it's difficult because obviously companies are saying we can't give any guidance, and that's fair enough. They're flying slightly blind. So, I mean, the only way I can sort of look at things is to look at what they made last year on the basis that I would hope that at some stage, maybe after this year, maybe next year, they'll make something like they made last year, and look at the valuation on that basis. So in a way saying we're looking at a lost year of earnings. Maybe that's too optimistic, but at least that's some way of getting a baseline. But also looking at that other point about, will the company be there in a year's time? And if you have doubts about the company being there in a year's time, then you shouldn't be investing in it anyway, I guess.
But do you want to be in a company where there's no earnings growth? Isn't it better to have cash or put it into something that is growing?
Yes, I guess so, but it's a matter of what price you pay for anything. And to me, is that how do you value a company? Do you just value a company on 1 year's earnings growth? I mean, you've got to remember, we often value a company on what? We say, oh, this is worth 15 times earnings. So you're saying I'm prepared to pay 15 years of profits to buy this company. So if there's 1 year where it's not going to make any profits, does that mean it's worth nothing? Obviously, if it carries on for a second year and a third year and a fourth year and a fifth year, it's definitely worth nothing. But if it's got a good long-term franchise and things will come, will recover, then. But you've just got to work out what the sort of current valuation is saying about the business. And certainly in the middle of March, you've got a lot of companies that were down on 8, 9, 10 times earnings. So I think that's starting to discount a heck of a lot of bad news.
Let's move over to David Kempton.
Yes, I would have thought the debt that is building is absolutely massive. On the other hand, cheap oil must be a great benefit to people. Also, the $2 trillion that's coming into the US economy must have a significant difference on spending there, so that every country is pumping massive amounts of cash into the economy, and we have got cheap oil, and there is massive pent-up demand. And I would have thought that when we all get back to normality, there will be a significant rise in stocks from here. And I'm with you on the V-shaped economy, because the massive amount of money that's going to come back with a surge, it's going to be general party time. Would you not agree with that?
I do agree with that, because again, it's sort of looking at across the whole economy and the aggregate. Now, of course, someone on universal benefit who is struggling like mad, spend every penny they get, need more. They've been given an increase, and they'll be spending every penny of that anyway. So that's the same as always, but actually we've got a bit more to spend that will be spent. Then you've got a lot of people who are only being paid 80% of what they were being paid. I suggest that, again, they probably, a lot of them will spend every penny they normally do, although at the moment they'll be struggling to spend anything. And then there will be the better off and wealthier people who are still being paid and haven't lost their jobs and things like that. And again, their balance sheets will be looking a lot better. I'll be fascinated to see what the UK savings ratio looks like for this period, in a year's time when we look back at it. And I think it's going to cause a lot of pent-up demand, which will get spent.
Yeah, we can't spend any money, can we?
No.
So we've got a question from Michael Broom-Smith, who says, from my calculation from the peak in September 29, the Dow Jones Industrial Index did not hit the same figure again until 1954. What leads you to believe it's different this time, both in terms of the fall from the highs and the time taken to recover? Jobless claims in the US today were horrendous again, and it's only the beginning.
Hi, Michael, by the way. I think that if you look back at the 20, I've read the odd book on it, but there were some huge sort of mistakes made by the authorities, the government, the president, in terms of a sort of laissez-faire attitude in many ways, certainly for the first few years of this. It was a sort of almost like, well, people deserve that. Whereas we're living in a different era now. We're living in an era of, almost, it's just the amount of money that is being pumped in, which was absent in the late 20s, the early 30s. So I think that's what will be different, because that money basically has to go somewhere, and it's going to go into the economy. It's also going to go into asset prices once we come through this. And the other thing about the US, they are very much a hire and fire economy. It's very easy to lay people off, very easy to hire them again. These figures are horrendous. But the other side of it is, in 1930, they didn't all get checks through the post, which is happening this time. And I'll tell you, if this goes on longer, they'll get another check. So I just think it's the amount of money going into it that makes this different from the Depression.
And we'll take one last question, which is John Hughes.
Hi, Tamsin. Hi, John. It's a very useful webinar. Just a quick question. Do you have an opinion, John, on how asset managers would be impacted with maybe significant redemptions? Think people like Premier Miton, Lion Trust Asset Management, or Tatton Asset Management?
Yeah, and I guess that's always the risk as markets come down and people sell out and take their money out of funds and things. So, and a lot of these asset managers, I have held them in the past. Things like Miton I've held, Polar Capital I've held in the past. But a lot of them try and build in quite a lot of flexibility into their cost structures. So the basics of the cost they try and keep low, and then obviously when times are good and there's performance fees, etc., then they pay bonuses. Most of their costs are in the end their people, but they will get hit. But if you can get the timing right, when you think we're at the bottom, there could be quite a nice sort of geared, in quotes, play on any recovery.
Yeah, certainly from PE terms, they look good at the moment, but then what is their earnings going to be? It's hard to.
Yeah, exactly. That's the worry. If the thing to do, actually, it's quite a lot of these investment companies. They obviously manage funds or investment trusts or whatever, but they also manage funds, and you can basically, they'll be producing monthly fact sheets, so you can get a feel if you've got the time for what's happening to the funds they manage. Some sort of indication. Yeah, you don't sort of have to wait for the actual management companies to make their quarterly announcement or whatever.
We'll leave it there, John. Why don't you tell people where they can find you?
Well, it's www.johnsinvestmentchronicle.com.
And your Twitter handle?
At John Rosier, I think.
Brilliant, John.
Yes, thank you to everyone. But remember, these are just my views. I could be wrong. I often am. But good luck and stay safe.
Well, many, many thanks for a great webinar. Do tell your investing friends about PI World. Write comments on bulletin boards or Twitter, or even comment on YouTube about any of our videos. We'd like to go on providing these free webinars, and getting good speakers like John relies on the audience numbers we can attract. So, as John says, many thanks to you all for joining us, and stay well.